Financial doomsday machine. How China could crash the US economy. Imagine waking up tomorrow to find your mortgage payments doubled overnight, your retirement savings cut in half, the cost of everything from gas to groceries skyrocketing beyond belief, global markets in freefall, the dollar crashing 30% in 24 hours, emergency Fed meetings called amid Treasury collapse. This isn't science fiction. It's what economists call the financial doomsday scenario, and China holds the trigger. What's up, everyone? Today, we're diving into what might be the most dangerous financial weapon on the planet, one that could annihilate the American economy without firing a single bullet. Here's the wild part. Most Americans have no idea it exists. I've spent months researching this topic, interviewing economists, and analyzing data that frankly keeps me up at night. And in the next 15 minutes, I'm going to show you the secret financial weapon China has been building for over 20 years, why it's more dangerous now than ever before, the 3 warning signs that would tell us they're about to use it, and what you personally can do to protect yourself if the unthinkable happens. This isn't about fear-mongering. It's about understanding the precarious balance of global financial power that affects every single one of us. Let's dive in. Most weapons in history are physical things, missiles, bombs, warships. But in the 21st century, the most devastating weapons might be invisible, existing only as numbers on a computer screen. China's weapon, $760 billion of US Treasury securities. You might wonder how owning US debt could be a weapon. To understand this, we need to grasp something called mutually assured financial destruction. The global economy isn't just about trading goods, it's about the complex web of debt that connects countries together. And the relationship between the US and China is the most consequential financial relationship in human history. Let me break this down into simple terms. Americans buy massive amounts of Chinese products. This creates a huge trade surplus for China, over $300 billion annually. China ends up with mountains of US dollars. They use these dollars to buy US Treasury bonds. The US uses this money to fund its government and keep interest rates low. It's like a strange financial perpetual motion machine. We buy their stuff with dollars. They loan those dollars back to us. We use those loans to buy more of their stuff. But here's where it gets dangerous. This cycle has created a situation where China essentially has its finger on America's financial pulse. If they decided to suddenly dump those treasuries or simply stop buying new ones, the effects would ripple through the entire US economy and your daily life, with devastating consequences. This didn't happen overnight. China's treasury holdings grew from just $60 billion in 2000 to a peak of $1.3 trillion in 2013. They've since scaled back to about $760 billion. But that's still enough financial firepower to cause serious damage. To put that in perspective, that's more than the entire GDP of Saudi Arabia, about $2,300 for every man, woman, and child in America, and enough to buy every NFL, NBA, MLB, and NHL team 5 times over. But raw numbers don't tell the whole story. The real power comes from the potential market reaction if China were to weaponize this position. Financial experts agree that the treasury market is incredibly psychological. If China signals they're moving out, others will follow. It's herd behavior that could trigger a cascade of selling. And that's what makes this scenario so dangerous. China doesn't need to sell everything. They just need to create enough panic to start a stampede. So what could actually prompt China to pull the trigger on this financial weapon? After speaking with geopolitical experts, 3 scenarios emerge as the most likely trigger. Number 1, Taiwan invasion response. If China moves on Taiwan, the US would likely impose severe sanctions. China could retaliate by dumping treasuries to create economic chaos in the US, potentially weakening America's ability to respond militarily or maintain allied support. Trigger number 2. Dollar de-weaponization. China is already leading efforts with BRICS nations to create alternatives to the dollar-dominated financial system. If the US imposes harsh financial sanctions similar to those used against Russia, China might accelerate this process by dramatically reducing its dollar holdings. Trigger number 3. Internal economic crisis. If China faces severe domestic economic problems, like a real estate collapse or banking crisis, they might need to liquidate foreign assets quickly to shore up their economy. Regardless of the international consequences, any of these scenarios could transform China's treasury holdings from an investment into a weapon of financial mass destruction. So let's say China does start selling. What happens next? The first domino. Bond prices would plummet, causing interest rates to spike. Remember, when bond prices go down, yields go up. This would trigger a chain reaction. US government borrowing costs would skyrocket, mortgage rates would surge, potentially crashing the housing market. Stock markets would likely plunge as investors flee to safety. The dollar could sharply depreciate. Inflation would accelerate as imported goods become more expensive. But here's where things get interesting and why China hasn't pulled this trigger yet. It would be like setting off a bomb while still in the blast radius. If the US economy crashed, who would buy all those Chinese exports? China's economy is still heavily dependent on selling to Americans. Plus, the remaining value of China's treasury holdings would collapse. Selling $760 billion worth of anything crashes the price. It's like trying to sell a mansion in a housing crisis. This mutual vulnerability is why economists call this financial MAD. Mutually assured destruction, similar to the nuclear standoff of the Cold War. The US isn't defenseless against this threat. The Federal Reserve has its own financial nuclear option, something called yield curve control. If China started dumping treasuries, the Fed could simply step in and buy them up, essentially creating new dollars to purchase the debt China is selling. The Fed demonstrated this power during COVID when they expanded their balance sheet by over $4 trillion. They could theoretically absorb anything China throws at the market. But this solution comes with its own risks. Massive money creation could supercharge inflation and potentially undermine confidence in the dollar itself. It's like fighting a fire with gasoline. It might work in the short term, but creates new dangers in the process. The reality is that China has already begun a strategic retreat from US treasuries, but they're doing it gradually to avoid creating panic. Since 2013, China has reduced its holdings by over 40%, but they've done it so slowly that markets barely noticed. This slow burn approach accomplishes several goals. It reduces their exposure to the dollar, it frees up capital for their Belt and Road Initiative, it avoids triggering market chaos, and it allows diversification into gold and other currencies. China's playbook isn't about creating a financial apocalypse. It's about slowly, methodically reducing America's financial leverage while building alternative systems. Their gold purchases have surged 400% in the last decade. They're creating digital currency technology that could bypass the dollar-based SWIFT system, and they're establishing trade deals denominated in yuan rather than dollars. The real danger isn't a sudden financial attack, it's the gradual erosion of the system that has underpinned American economic power for decades. So what can you do to protect yourself against these financial threats? First, understand that diversification has never been more important. Having all your assets in dollar-denominated investments could leave you exposed if the worst-case scenario materializes. Consider allocating a portion of your portfolio to inflation-protected securities, hard assets like precious metals, broad international exposure, including emerging markets and companies with strong pricing power that can weather inflation. This is not financial advice. Always consult with a qualified financial advisor before making investment decisions. The goal isn't to panic, but to be prepared. Financial history shows that the most devastating crashes often happen when people assume systems are too big to fail. Conclusion. We've covered a lot of ground today, from the mechanics of China's Treasury holdings to the potential consequences of a financial standoff between the world's two largest economies. The truth is, we're living through an unprecedented economic experiment. Never before has one country owed so much money to another, especially not a geopolitical rival. But there's a silver lining to all this. The very interconnectedness that creates these risks also creates strong incentives for both sides to avoid catastrophe. It's in nobody's interest to collapse the global financial system. What we're likely to see instead is a slow, careful dance as China gradually reduces its dollar exposure while the US works to stabilize its fiscal situation. It's not apocalypse, it's evolution. What matters is staying informed, understanding these massive forces that shape our world, and taking reasonable steps to protect yourself and your family's financial future. If you found this analysis valuable, hit that subscribe button and notification bell. In my next video, I'll be diving into how the Federal Reserve actually works and the hidden ways it influences your daily life. Thanks for watching and subscribe to watch the next video.